Good morning, everyone. Whether you're joining live or whether you're watching this on playback, thanks for joining us today for the JPMorgan European Growth and Income presentation as part of our series this week of Kepler rated trusts. Clearly, there'll be people here gathering information who may be part of the transaction with European Opportunities Trust, so it's a good opportunity to hear how this trust has been managed over the last few years. You'll understand if Zaina can't say too much about that transaction, but clearly there'll be a document going to shareholders in the very near future. JEGI's final results just came out this week, so there's plenty of information in there, and I think one of the most notable things about those results and indeed performance over the last few years is that whereas the European markets have risen quite positively, there's been a big dispersion in how active managers have operated in that constructive market, and JEGI has really come out with very strong performance by applying its process, which Zaina is going to talk about in a moment, very consistently. So it's a kind of notable time to be reflecting on the last few years and looking forward as to what's next. And so just with a little bit of housekeeping for those who are new to these presentations, the bottom right hand corner you'll see Q&A. You can type questions in there. I'll be monitoring those while Zaina's talking. She's going to speak for 25 minutes perhaps, and then there'll be 20 minutes for Q&A at the end. So please do put questions in there and we'll try to get to those. The slides will be available for download afterwards, and you'll be able to watch this back as well. You'll get a notification when that goes up on the website. With that, I'll pass over to Zaina.
Great, thank you, Alan, and good morning, everybody. Thank you so much for joining us today. I'm Zaina Shuhaber, one of the fund managers of the JPMorgan European Growth and Income Trust. We call it JEGI for short, and very pleased to be here today to tell you more about our investment trust, focused on capturing opportunities across the European markets. Whether you're already familiar with our trust or just starting to explore European investment opportunities, today's session will hopefully give you a reminder on why we think European equities play an important role in your portfolio and why we think JEGI is the best way to do that. So let's have a look at the agenda first. We'll first look at things from a top-down perspective. We'll identify some of the structural tailwinds that can continue to support European equities, especially as the asset class continues to look attractively valued in comparison to history. I'll then get into our approach of active investing and tell you a little bit more about how we identify stocks, how we build the portfolios in a suitable way for investors who are looking for that core offering within the European equity space. And then finally, we can go through some of the stocks that we're excited about in our portfolio and demonstrate that Europe is a market that still has plenty of stock-specific opportunities for active managers and things that we think are very interesting for our investors. So we think there are three key reasons why Europe warrants a look from investors. Firstly, in terms of fiscal support, we believe the fiscal stimulus impact in Europe is real. We believe that this is only just beginning, and we'll have some charts on this a little bit later in the pack as well when we talk about some stocks and some themes that are coming through in our portfolio. And while much of the market's attention has been focused on US tech, and rightfully so in some ways, we're seeing a significant shift in the narrative across the Atlantic that makes European equities also increasingly attractive. A primary driver of our renewed interest is also this emergence of targeted fiscal stimulus, particularly in Germany, where a broad-based package is being deployed to revitalize what is basically the continent's largest economy. And unlike sort of a broad blanket sort of measure of the past, this is a wave that strategically is focused on three critical pillars. So whether that's defense spending, the energy transition, transport infrastructure, and this has broad implications for a variety of sectors that have pretty good representation within the European market. And that includes industrials, utilities, capital goods, and many of these companies are really poised to capture increased demand from government-led infrastructure and reindustrialization projects. And then beyond fiscal support, we're seeing a critical shift as Europe addresses its competitiveness gap as well against global peers. Following the Draghi report, the EU has launched this competitive compass, and this really is a strategic pivot away from the bureaucracy historically, which would have really acted as this invisible brake on regional growth. And this deregulation is already translating into tangible policy such as streamlined permitting for energy projects, Germany's upcoming income tax reforms, and a variety of other different things. And from an investment perspective, this structural easing creates a very durable foundation for earnings that we believe are currently, underpriced in some of these industries and some of these businesses. And once we see business confidence begin to improve across countries like France, Germany, etc., we see this compelling opportunity to capitalize on a region moving from a defensive stance to one of global competitiveness. And as investors, we find the shift towards deregulation particularly compelling because the market is always focused on these short-term data points, but often it's these sort of structural reforms that create a more durable foundation for corporate earnings over the longer term. And then lastly, these tailwinds for earnings growth aren't being reflected in valuations. We've seen other markets re-rate quite significantly this year. We think that in Europe in particular, the market still is trading in line with its long-term history, despite what we believe to be an improved outlook. And I think there could potentially still be room for earnings growth, coupled with obviously some of that earnings growth that we'll talk about. So moving on to the next slide. Of course, we have to acknowledge some of the risks on the horizon. While the recent progress on US-Iran peace plan is a positive step, I'll be the first to admit that predicting geopolitics is a very humbling experience. And over the last 5 years, headlines have really been dominated by a relentless cycle of crisis, and even longer if you kind of go back a little bit further than that as well. But obviously you had Russia, Ukraine, which is still ongoing. You had the 2023 global banking stress. You had U.S. elections and Liberation Day, and now obviously the shifting dynamics in the Middle East. And however, the most important observation from this period is that while geopolitics drives kind of very short-term headlines, we really believe that fundamentals is what really drives the long-term returns. And history shows us that these bouts of market volatility are often opportunities in disguise. In the long run, markets have a remarkable ability to tune out of kind of the geopolitics, the noise, and really refocus on corporate earnings, innovation, structural growth. And our strategy really remains focused on these enduring drivers rather than trying to time, the next headline or the next political move or the next comment from any particular leader. And when we look over returns over the same period, I think it's important to note that Jaggi shareholders would have doubled their money despite a lot of these things that at the time seemed quite challenging from a market perspective. And this doesn't just exceed the returns that are generated by the European index, which is shown on the yellow line below, but also if we look at this slide that I'm showing here, the performance of the S&P. So while the US and tech stocks in particular have received a lot of the main headlines, there have been pockets of European equities, be it in banks, utilities, even telcos, that have generated healthy returns and serves as this important reminder that diversification really is what is the key to sort of long-term success in investing. And these opportunities are now being recognized by the market, by your peers, by the investor community. So for the first time in almost a decade, we are seeing money return to European equities. So the yellow bars are basically ever since we've started to see net inflows, and there has been 66 billion of net inflows in European equities over 2025 and year to date so far. And importantly, these trends tend to last. They tend to be sort of multi-year trends. And we believe that we're just at the beginning of that cycle, which would really support the asset class for quite some time. So if you do agree with that as a market backdrop, the next question is how to access it. And we believe that JEGI is obviously is built to kind of do just that for our investors. So let's just dive straight into the three main highlights that we talk about when we're referring to JEGI. So number one is our investment objective and approach to investing. Number two is how do we make full use of that investment trust structure with our dividend policy and our approach to gearing. And then last but not least is the performance track record. So to begin, our aim is to deliver a core portfolio for investors by selecting European stocks outside of the UK. And we focus on companies that as a group are not only attractively valued, but also demonstrate higher quality and stronger momentum. So to achieve this, we're combining the strengths of our quantitative analysis as well as our fundamental analysis. And we'll get into this in a little bit more detail in the future slides. But really, this dual approach is what allows us to invest confidently across the market cap spectrum, so across different company sizes, from the larger established firms like ASML, like Allianz, to smaller businesses that you might not hear about every day. So SPIE and Doe & Co, SBM Offshore being some examples there.
So,
and the result has been...
Zaina, could I just interrupt for 1 second? Your colleague, who I think might be standing stage left, has pointed out that your headset is a bit crackly. So we're going to take a pause and move into the green room for a second while we test a different headset so we can get clearer audio. If people would just bear with us for a minute, we'll be back shortly. Thanks everyone. We're back with better audio, so I'll hand back to Zaina.
Sorry about that, everyone. A few technical difficulties, but hopefully you can hear me better now. So what I was saying before was just in terms of our stock selection process, and we're going to get back to that in more detail anyway later. So apologies for having interrupted that part. But ultimately, what we're trying to do is build a portfolio that is well diversified, not just by stocks, but also by country, by sector, by investment style. And this really helps us manage risk and still have the ability to capture opportunities wherever they arise in the European market. So coming back to my second point, in terms of how we make use of this investment trust structure, a key feature of our trust is our commitment to paying an annual dividend of 4% calculated based on the NAV at the end of each fiscal year. So that's usually a March year end, and then paid quarterly. And what's important for our investors is that we can maintain this dividend policy without compromising our investment decisions. So as portfolio managers, this means that we can really focus on selecting the best companies from a total return perspective, rather than being forced to chase yield. So, for example, we don't want to be buying a stock just because it pays a high dividend. We can focus on the quality of the business and whether the prospects are improving or deteriorating, and that's really helpful. And then another way that we take advantage of the investment trust structure is via gearing. So our approach to gearing is quite consistent with our core approach. We know that markets go up over the longer term, and we want to be able to use our gearing facility, but we also don't want it to be the main driver of returns. And therefore, we tend to keep it at a modest mid-single-digit level, because ultimately we know that we're not good at timing the market. So like that definitely helps us in terms of sort of smoothing out those returns over the longer term. And then finally, turning to performance, as the chart on the right shows, our approach has delivered consistent outperformance both over shorter and longer term periods. shareholders would have generated over 25% over the last year, nearly 15% per annum over the last 5 years. And we really believe that a key reason is that our process has historically worked in both value-led and growth-led markets, which is really important when leadership changes across market cycles. And compared to peers, we think that it's really this discipline, this diversification that has been very central to that consistency. So in summary, JEGI offers investors a core diversified portfolio, a focus on quality, value, and momentum, plus a reliable income stream. And it offers this balanced portfolio that is diversified across countries, sectors, company sizes, investment styles, rather than just kind of betting on one theme or one part of the market. So let's go back to maybe our investment process and elaborate on that a little bit more. What we look for when we assess a company. So at a high level, we ask ourselves, these 3 questions. And, to be clear, these are very simple. Everyone wants good businesses at good prices with things improving. But really the key difference is how we apply them. So we're not necessarily relying on sort of like good meetings or just compelling stories. We're really looking for sort of hard evidence, numbers, in what businesses are actually delivering. So let's take each in turn. So the first one is it a good business? And we define this by profitability and resilience. For example, we're looking at measures like return on invested capital. So basically, how efficiently is a company turning investments into their profits? And a good example of this is Ahold Delhaize, which operates as supermarkets in the US and Europe, not traditionally a good business, but they have strong market positions. They have a consistent record of generating cash and a very disciplined approach to growth. The second one being, is the valuation attractive? And I think valuation has mattered for a long time. And it's been a meaningful contributor to performance in recent years. So that's definitely for sure. And we focus just on straightforward metrics like price to earnings, free cash flow yield to judge whether a stock is priced to offer a good return from here. And then finally, in terms of momentum, we're looking at both operational momentum as well as share price momentum. And in our experience, companies that are improving continue to improve for a period of time, and then the opposite can also be true. And recent examples are obviously parts of the AI supply chain, such as semiconductors, where fundamentals and market trends have been strong. So that's been, a lot more of a positive place to be in these markets. So how do we actually look for these ideas? Our process brings together the best of quantitative and fundamental insights to help us meet our portfolio objectives. And, there are pros to both and cons to both, which is why we believe the combination is really powerful. And I like to think of it as thinking about sort of the man and the machine. So quantitative analysis is great at processing large amounts of information, very consistent, very systematic. You can get a broad universe of companies in there, and it really adds discipline to the decision making and supports the idea that our process performance is repeatable. Fundamental analysis is better at understanding the why behind the numbers, and especially when data is less clear cut. So it can help us recognize maybe changing business models, assess one-off or binary risks, for example, an upcoming drug trial within the healthcare sector. And crucially, our process is designed to make practical use of research and data outputs and basically turning insights into portfolio positions in a very disciplined way. And we can bring this a little bit more to life when we talk about some of the stocks in our portfolio. So moving on to portfolio construction and how this kind of all comes together, we really believe that successful fund management is about more than just a collection of good ideas. It's really about how those ideas work together. And in our experience, portfolio construction, it tends to be the more boring part of these conversations, but we really think it's just as critical as stock selection. So think of our portfolio not just a list of best ideas, but really it's a very carefully engineered machine. So while picking the right stocks is vital, how we assemble them is actually really what manages the risk within the portfolio. And we take this really high, a very intentional approach to this. We look at how each stock fits into the big picture. We don't want any single, all of these bits and pieces return profile for our investors. So, a few minutes ago, I told you a little bit about our stock selection approach. Those three questions: is it good quality? Is it cheap? Does it exhibit momentum? And obviously, in an ideal world, every stock that we select would check all of those boxes. But in reality, depending on the market backdrop, that doesn't always happen, and that's just the way things are. But what is absolutely crucial is, and what we do always want to see, is that our portfolio as a whole will exhibit all of those characteristics, and that at all times we have a portfolio that is better quality than the market, trading at more attractive valuations, and demonstrating better momentum. And that's really sort of like the key signature of what JPMorgan is. So moving on to performance now, the key to successful investing isn't just chasing the most recent returns. It's really about understanding how a portfolio behaves over different market cycles. And ultimately, a consistent long-term track record is what truly rewards our investors. And that is what we tend to be most proud of. So over the last decade, we've navigated a variety of different environments. We've had growth-dominated rallies, we've had bull and bear markets. And we really believe that rigor and discipline of our investment process are exactly what has allowed us to stay the course and really drive those long-term results. So while our focus is always on the long term, we can also see some of that discipline reflected in some of the outperformance over the past 12 months. So for the year ending April, the fund outperformed its benchmark with a share price total return, as I had mentioned before, of nearly 26%. So on the following slide, we can have a look at specifically what drove those returns. So in line with the way we manage portfolio, we would expect that our returns come from a variety of different sectors, which we can see on the left-hand side of the slide, and also a variety of different stocks, which comes on the right-hand side of the slide. And the reason why we have those parameters in place is because we don't just want one idea to be dominating our returns, whether that's on the positive or negative side. So one of the positive drivers was stock selection within the capital goods sector of the portfolio. This was driven by owning stocks like ABB, Prysmian, Siemens Energy. Ultimately, these companies played right into the themes of fiscal spend and the energy transition, and we'll talk about those in a few minutes on some of the following slides. Banks were also a notable source of strength, given the combination of the strong earnings cycle that we've seen and also re-rating from a sort of lower valuation base. So especially Italian banks like UniCredit on the larger cap end of the spectrum, or BPER Banca towards the mid-cap range were also really good examples here. And then on the negative side, you can see how some of the strong share price moves of non-held names, so BBVA, Nokia, ANI, were some of the main detractors. But even with some of those share prices doubling, it wasn't really enough to sort of outweigh some of the more positive stock selection that we had over the course of the year. So let's move on now to some of the stock examples in our positioning and why we think that Europe is an interesting place to invest. You'll recall I spoke earlier about the pivotal shift in Europe's fiscal stance, most notably from Germany, which of course is the country's largest and most financially stable economy. And what they're going through isn't just like a policy tweak. I think it genuinely is a strategic reversal after 2 decades of underinvestment. So if you see on the left-hand side of the chart, and we've excluded the crisis years in this chart, but ultimately the European government investment has consistently lagged behind the US, which is the gray bars. And that gap is now closing fast. And critically, we don't think that this is just short-term stimulus, but it's actually like a decade-long commitment backed by credible fiscal politics and consensus views around the kind of lack of investment that has been the case over the last decade or so. And what makes this shift so powerful is that governments are directly driving the capital allocation. They're not just enabling the growth, they're rebuilding. They're really leading that rebuild of strategic infrastructure from defense to electrical grids. And this is really like this buy order from the state. And we're really, we think that we're quite positioned, well positioned to capture it. So a couple stocks that fit into this theme, take Thales, for example, Europe defense stock. They don't build the sort of tanks or jets, but they're more about sort of thinking about modern defense. So things like radars, secure battlefield communications, government cybersecurity. So as nations move to meet or even exceed some of their NATO 2% spending targets, much of this 800 billion rearm Europe push is flowing to local companies as well. In their latest results, they reported a 27% year-over-year surge in orders. So, huge growth, and that's really been fueled by long-term government contracts. And then defense isn't the only priority for governments. Europe's reindustrialization also hinges on, the basically industrial grade infrastructure. And, we can't open new factories and expand ports or deploy data centers without reliable, scalable power delivery. And that's really where something like an ABB comes in, which is a Swiss company. And they build like a lot of the equipment that is kind of behind the scenes, so things like circuit breakers, switchgear, automation systems that keep the electricity flowing safely from the grid to the end user. And as government greenlights more of these infrastructure projects, ABB is basically seeing unprecedented demand. So again, for them, their year-over-year order growth has been 44% over the last year or so. And that really, for us, signals a very structural upswing in some of these things. And these aren't isolated winners, as we saw in the previous slide, in terms of where our attribution has come from. They're really early validation that European fiscal policy has shifted. And we believe that this theme becomes a core driver of equity performance across the region for many, many years. And then the shift in government spend doesn't just stop at sort of defense, general industry. It really flows into, one of the most ambitious investment projects in the global economy, which is, the energy transition. And this challenge is quite simple, but it's huge, right? We're moving away from being centralized on fossil fuel plants towards a system that's being powered by wind, by solar, by gas. And this creates a massive bottleneck, though. So clean energy is often generated quite far away from where it's needed. And its supply is very variable as well. So the real opportunity isn't just in the pure renewables, it's also in the enablers of this transition and actually bringing this power online. And that's really where something like a Siemens Energy comes in, for instance. They provide the grid technologies that move power along sort of very, very long distances, and then connect the new supply. They also maintain they also have a very good world leading gas turbine business. And in this transitioning world where we do need more gas basically acts as the vital bridge, providing flexible power when the wind isn't blowing, the sun isn't shining, unlike today's situation. But and without this balancing act, basically the transition just stalls. So while Siemens Energy builds the physical assets and is very important within that framework, you can think of E.ON as sort of managing that platform. And they've basically, E.ON as a stock, a German utility, has evolved from a traditional utility into basically Europe's digital playmaker, digital house. And they're the ones doing the modernizing of this distribution grid, and they handle sort of the complex sort of two-way flow of energy from millions of solar panels and onto sort of EV chargers or wherever the actual power is needed. And you can think of that as kind of like last mile delivery. So in the UK, for instance, they have a project called Ectogrid in London that connects over 6,000 homes and businesses and to share waste heat. So basically, they're basically proving that the future of energy is quite decentralized, but it's also really, really efficient. So there's not a lot of wastage that kind of happens from all of that energy that's being sourced further away, and it can actually enter our system. And we really think that this, in general, this sort of energy transition is really a story of compounding growth. And by holding both the builders, but also the managers of the new infrastructure, we really think that we're positioned at the heart of what is kind of a multi-decade mandate to rebuild a lot of the European grid. And then finally, one other important theme before heading to wrap up the presentation part and moving on to the audience Q&A, AI, obviously a big topic, and rightfully so, given the huge amount of capex that's being spent. So what you're looking at here on the left-hand side is is the huge capex curve in that we've seen since in modern history. And not so long ago, when we thought about the annual infrastructure spend of hyperscalers, so thinking of the companies like Amazon, Meta, Google, Microsoft, that was around $150 billion. And importantly, it was really easy to forecast that over time. So basically, the wiggly lines on this chart show how CapEx estimates have changed for each respective year and evolved over time. So if you look at that purple line at the very bottom, in 2021, the market believed that companies would spend around 120 billion in 2023. And ultimately, that was pretty accurate, and that didn't change much. And you can see that because the line has stayed steady sort of over that time. What we are now seeing is this kind of rapid acceleration in spend that wasn't anticipated by the market, and that's what's basically taken everybody by surprise. So if you take, for instance, the orange line, which is for 2026, 2 years ago, the market expected that in 2026, capex would be around $250 billion. And that number is now more like $650 billion and still growing. So that's really what's taken the market by surprise, what's taken us by surprise as well in terms of the amount of capex. And for us as investors, the smartest way to play this isn't necessarily by picking, which AI model is winning, but actually by owning the picks and shovels. So basically, where is that capex going and which companies are going to be benefiting from this on the revenue side? So at the very top of that chain is ASML. So before an AI chip can power a model, it really has to be printed. And ASML effectively holds a global monopoly on the most advanced lithography machines required to do this. So these are very complex machines. They cost more than $200 million each. And the waiting list is, stretched out multiple of years into the future. So, quite simply, without ASML, the AI revolution doesn't get built. And by holding the stock in our portfolio, we benefit regardless of which tech giant kind of comes out on top, because ultimately they all need the machines that the ASML produces. And then we have Legrand as well, which is less glamorous, but equally vital and important for data centers. So if you've ever been inside a data center, then you are basically surrounded by Legrand products. And this company basically provides the plumbing, the wiring, it's the physical racks, the power distribution, and the cooling systems that basically stop a server from overheating. And what's exciting here is that AI has fundamentally changed these requirements for all of these facilities. And the latest AI chips now require over 100 kilowatts of power per rack. So that far exceeds what was the traditional requirement in data centers and the data centers being built to handle at that time. So that means that existing facilities aren't just expanding, but they're also being refurbished, completely redesigned, upgraded in order to cope with all of that heat that's being generated. And Legrand is really at the forefront some of these next generation solutions, and data centers now accounts for around 20% of their revenue, growing at about 20% per year for the last 5 or 6 years. So it is an essential sort of highly profitable and fast-growing business that kind of perfectly focuses on quality companies, structural tailwinds that we find within the AI sector. So just kind of some concluding remarks and looking back at what we've covered so far today. Firstly, I think the macro trends remain relatively favorable. Governments have recognized the need for fiscal stimulus and easing the regulatory burden to enhance competitiveness within Europe. Meanwhile, valuations also remain quite reasonable. Of course, this doesn't come without risks, geopolitics being one of them. But history has shown us that these periods tend to present opportunities for longer-term investors. And ultimately, the examples that we've discussed today, from complex lithography like ASML to essential infrastructure of Legrand, these outputs are very deliberate investment process. It's the outputs of a very deliberate investment process that we use to select stocks. And by combining quantitative and fundamental research, we just aim to strip away the noise and really focus on what truly determines long-term value. As we've seen over the last decade, the market's environments will shift, geopolitics will remain unpredictable. However, by maintaining this carefully engineered portfolio that prioritizes discipline, investment process, and focuses on diversification, we believe that we can navigate that volatility, and we really remain committed to this rigorous approach to help us ensure that JPMorgan continues to deliver for our investors across every cycle. With that, I'm happy to go straight towards Q&A, Alan, if there's any on the line.
Great. I want to start by going back to your earlier points about the inflows into European equities. So for a long time, if I could summarize it by saying, for a long time, European equities were attractive because, as you've touched on some of the companies, there's a lot of really great companies that kind of defy an uninspiring economic backdrop. But suddenly we've had this switch in the last year where I think you said 66 billion of investors have written out some bullet points that say why now. So not your bullet points, but what are their bullet points for why now? Is it Germany? Is it valuations? Is it banking? Is it I'm thinking Spain looks like it's coming out of a long dark periods post GFC, for example, or is it all those factors just coming together? What's the why now for the global investor who's put that 66 billion in the last year?
I think it's a variety of those things. If we think about kind of the macro piece, and you've laid them out pretty well. The one thing we haven't mentioned, I guess, is diversification. And I think after sort of a long decade of the US and technology outperforming, most asset classes, I think people have recognized that they need to diversify away from just kind of that single bet that they've had. And, obviously in the last 3 to 4 months, that bet has resumed itself and has, manifested itself in, semi's significant outperformance. And as a result, Europe has lagged in those months in comparison to countries where that is a bigger proportion of the benchmark. But going back to sort of like our long-term philosophy and the way that we manage your portfolio, you need to have more than one thing driving the returns in your portfolio as you kind of construct it. So I think that's probably the rationale behind a lot of that thinking, that there is more that you can get your portfolio to do other than just sort of relying on that one part of the market.
Mm-hmm. And then going to one topical sector, which you briefly referenced in one of your examples, there maybe I think it was at the back end of 2024. There was a kind of almost a meme trade in defense stocks, and they all went up, and since then they haven't really. And I just wonder whether there's more to it than that. And you know, we can come on to your smaller companies exposure in a moment as well. But you know, I've seen some observations that, you know, it's a bit like the pharmaceutical versus biotech industry, where innovation is happening in smaller companies and large companies might take them over. Is that something that you see happening in defense? You know, if someone bought Rheinmetall 6 months ago, for example, they might be a bit disappointed that it hasn't followed the rhetoric, for example, but smaller companies seem to be doing quite well. How are you seeing it?
Yeah, I think that's a really important point, because obviously we talk about some themes that are driving the market. We talk about themes that are really important to the sort of like structural case for Europe, but also important is to understand the impact on stock selection. And that's, you know, where active investing really matters, and, you know, where it should really shine. We actually never got fully involved with the defense sector. Like we never went to an overweight position, for instance, in stocks like Rheinmetall. Initially, they had run away from us quite quickly, and then with our valuation discipline, we couldn't necessarily justify why it was trading on sort of 50, 55, 60 times earnings. Although we could see the narrative play through in terms of the macro side of things. But I mean, the one thing to sort of clarify is that we still think that defense spending will be a priority for European governments. I think it has to be. But that can have different effects on the economy. That can have a trickle-down effect in terms of labor, in terms of wages, in terms of you know, building out those production facilities. It doesn't necessarily mean that it manifests itself within defense companies within our benchmark, if you see what I mean. So from our perspective, and you know, even today, you see Rheinmetall share price down 12-13% at the open, and that was basically driven by a cancellation of the government of a multi-billion-dollar contract to make frigates. But you know, for us, it doesn't mean that Germany is necessarily, you know, stopping the taps on defense spend. It's just that they're really allocating where they think they need to, you know, they need to see an improvement. So some of that underperformance has come through because some of the order backlog hasn't come through. I think there is more competition in some of the smaller cap parts of the market, some of also the more privatized parts of the market, which don't necessarily feature yet in our universe. And obviously just a focus on margins as well. So like how can these companies necessarily, you know, translate some of those revenues into profit? And that's obviously extremely helpful, and you know, for a company's share price and what we're focused on in terms of thinking, does this make a good investment? So when we look at it today, you know, we don't have a big position necessarily in defense stocks. Actually, Thales is probably one of the few stocks that we have that's related to that sector in general. But we do think that it can still be a big sector and theme that sort of drives a European industrial recovery.
And do you just want to touch on how you access? I think you described them as off benchmarks, but essentially mid and small caps, because Jeggy is a very kind of carefully risk controlled portfolio, isn't it? But it does have this capacity to own mid and small caps.
Yeah, absolutely. And I think that's it's an important feature of Jeggy actually, because our for two reasons. I mean, obviously, the more large cap you go, the more people tend to think that the market is efficient. So having an investment process that allows us to access small mid cap stocks is really important in terms of getting a different avenue, a more diversified source of alpha, basically. And it really is that quantitative part of the process that allows us to kind of narrow in and zoom in on where should we be focusing our attention on some of these companies that perhaps also like our peer group doesn't own as well, because you know, they're more reliant on the large cap end of the spectrum. So currently we have around 13-14% of the portfolio that is in off benchmark stocks, and it's kind of a proxy for thinking about smaller mid-cap names. And they span kind of a variety of different sectors, but I think today they're a lot more focused on a lot of the more infrastructure side of what's happening in Europe, but also globally. So for instance, one of the names in the portfolio is SBM Offshore. This is an energy services company that does, obviously a lot of offshore projects. And it's not just about gaining that a lot more of those contracts that are coming through, particularly in Latin America, but they're also transforming their business into a more sort of sale and operate business model. So that basically makes them a lot more efficient. And it's really capitalizing on that structural shift towards larger, more complex, deep water projects in Latin America. That's helping driving that sort of upgrade cycle. So we can access a lot of these companies as well, and we don't set ourselves limits in terms of a cap on the number of stocks that we have to own, for instance. So currently the portfolio has about 110 stocks. And for us, that's perfectly fine, because if you do have another idea and you think it will outperform, then we will make space for it, and we'll find kind of other areas and make sure that kind of the portfolio balances at the end, if that is the case.
Yeah. Okay. And you mentioned I'm mindful of time, but I know we had a brief pause, so I think we have a little bit more time. The recent volatility, I mean, there's been various sources of recent volatility. Obviously, a kind of ill-conceived war was one of those, but there was also, I'm going to say it, the SaaS apocalypse, if I if I can say that. And there are some signs that markets are now trying to go through the wreckage of that. In the investment trust sector, I think it kind of manifested itself a little bit more in private equity trusts that own these European software businesses. But nevertheless, has any of that volatility of this year and the back end of last year opened up opportunities for you, or are you still reassessing?
Yeah, I mean, just this year, for instance, software is down around 20%, semis are up 90%. So it tells you the kind of like the significant stretch that there is in the market. And we've been underweight software names like SAP, and that's done even worse than sort of like the average semi stock. So that's down around 35%. And then we've been overweight some of the more AI CapEx beneficiaries. So not necessarily just in semis, but also like within the capital goods, as we had discussed earlier. So names like Legrand, but then even some of the utilities companies that are kind of seen as beneficiaries of AI CapEx. And the attraction of stocks that appear as these kind of like AI losers that you've referenced is that they now look attractively valued. And this is also beyond software. It's things like media, it's IT services, exchanges, asset managers. The list kind of grew as we went through this year in terms of thinking about what AI could potentially disrupt in the future. The challenge, though, is that it's really difficult to disprove that narrative at the moment, and we might not know for quite some time to what extent these businesses might get disrupted. But then the narrative started to shift that maybe they're not disrupted because they're able to sort of incorporate some AI into their capabilities, but that their cost base would increase quite significantly with their token usage. So their margins would come down quite a bit, and they wouldn't warrant the valuations that we may have been seeing in the past. So we've addressed this in two ways. Firstly, we think about portfolio risk, and we've built our own sort of internal risk dashboard in general to think about a variety of different risks, sort of construct an AI winners versus losers framework as well, and then see that impact on the portfolio. So when we do get those reversal days where those AI losers are outperforming, to what extent would that impact our portfolio, and are we okay with taking on that risk? And the key here is really to just make sure that that number doesn't get too stretched, So again, kind of going back to sort of our philosophy around where we want returns to come from, we don't want one bet derailing our returns. So that really has been the main driver of trying to search for some of these stocks that we might not think are going to be as disrupted as the market thinks. And the way we've got into some of those stocks is working with our fundamental research team to come up with a framework for identifying where some of those stocks have perhaps been more unfairly punished. So looking at things like, who has a data moat, how embedded is a particular piece of software in a client's workflow, is there regulatory reasons around that, what would be the cost to switching that off and changing that system, who has the ability to integrate AI capability into their things. So in recent months, we have been adding a little bit more, but more focused really on exchanges, so things like Deutsche Börse, Euronext, even Publicis, which is a media company that we think, where that sell-off may have been overdone. So it's very sort of like small initially, but on the whole, we're kind of in a wait and see mode to necessarily understand, which of those businesses would be able to survive this a little bit more.
Yeah. And finally, just briefly, again, going back to reasons to be cheerful about Europe, do you see any opportunities in some of the more peripheral markets? So, for example, Poland is obviously a huge economy. It is actually a developed market, depending on which benchmark you use. But it's absolutely tiny, and you have this off benchmark capability. And I don't want to particularly focus on Poland, but just taking that as an example, are there any kind of more surprising peripheral opportunities that you're seeing at the moment outside of the kind of big reasons to be optimistic with Europe?
So Poland isn't part of our benchmark, and we will go off benchmark, but we will only invest in countries that are part of our benchmark, or companies that are listed in countries that are within our benchmark. So Poland, unfortunately, isn't in that. I mean, we do have a few names, for instance, within banks like BAWAG or Erste Group, that are listed in Austria but have like very good exposure to Eastern European banking sector, and those have been actually quite good markets to have invested in, and they are definitely seeing a lot more growth. And then obviously, if you think about historically what especially coming out of the sort of Eurozone crisis, and people being a little bit more averse to sort of investing in Southern Europe, in banks in particular, thinking about our exposure to sort of Southern Europe, like Italian banks, Spanish banks, that has been quite helpful over the last few years, and we maintain those positions. So I think that's kind of the best way to sort of capture a lot more of what's happening kind of on the ground through a more diversified part of European. And then obviously, I guess Greece comes into the benchmark, but that's not until I think second half of next year now. So we would have to wait for that to happen first.
Okay. Zaina, thank you so much. Thanks everyone for your patience with that little adjustment in the middle, and thanks for attending when the temperature is rising. As I said at the beginning, documents for the European Opportunities transaction will be out soon. Refer to those. This presentation is recorded. You'll also be able to download the slides, and please do email us if you have any burning questions that we haven't had a chance to cover. So with that, we'll wrap up, and I'll hopefully see some of you later today.
Thank you.
Zaina.